Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Please don't forget to like and subscribe. Click the bell so you get a notification of when we're releasing a new video. I'm sitting today with Willie Pelser. Hello, Willie.
Hello, Robin. Op je bokken.
Yeah. So we dressed a little bit casually today. It is casual day for persons with disabilities. So we dressed a little bit lighter, and I've got my sticker on. I've paid my 20 Rand. Yeah. So, Willie, there's quite a bit of concern globally about bond markets, and we have talked about it with Michael from time to time, just about where yields are. But bond markets are good indicators into global economics, global politics. They're things that we watch as equity managers very closely, even though we're not massive investors into bonds. We watch it very closely because it gives us a commentary, doesn't it? So
yeah, Robin, I think it's a good leading indicator, a perception indicator, and a feel for the market indicator. I remember Bill Gross, he was the head of PIMCO,
yes,
and he always said the bond market knows. So yeah, Robin, one can go into detail as to where yields are. In principle, all over the world, long-dated bonds, so those with a maturity of 10 years plus, every market that you look at, in principle, over the last week, 2 weeks, 3 weeks, yields have escalated. So they've weakened in price because of the inverse principle. So what do we read into that? And I've got sort of 5 things that I think the bond market is telling me.
So we've spoken with Michael quite a bit about the attack of Trump on the Fed, but there's a whole lot of other stuff going on, isn't there?
Yeah, Robin, it's much wider than that. So I've actually written it down because it's sometimes complex to remember these things. So the first one is fiscal uncertainty. So let's just use France as an example. So France is they're pulling a South Africa on the world in a sense of they don't know who to vote for. There's, all of these things, but it has a fiscal implication because some of the measures they want to bring through has a fiscal implication in the sense what's going to happen on the revenue line and what's going to happen on the expenditure line. So that's an impasse in a sense that's not coming through. And in the UK, the uncertainty is around growth.
Yes.
So bond markets is saying there's no growth, there's risk. So no growth, risk is there's no income on the fiscal side. Robin, the next thing is what we've seen, probably in the last or September normally. There's a big issuance month in the world from a government bond perspective.
Okay.
But what we've seen is massive corporate issuance as well. So it's drawing money in the sense it needs to come from somewhere. Now, if you've got policy risk on government side, but you've got certainty on a company, investors will probably go to the company. So they're taking up those bonds, obviously selling the fiscal.
And Willie, just a question on that. I mean, typically a corporate can borrow in the same way that government does through the bond market.
Exactly the same.
But there's normally a premium to pay relative because government is seen as less risky.
Yes.
Have those yields squeezed because people are seeing...
So Robin, that risk that you're talking about is, as I've just mentioned, so the uncertainty on the so-called risk-free, governments are risk-free, they're not. That's what the markets are saying because of the fiscal situation. But big companies, Apple, Microsoft, Caterpillar, and so on, those companies also issue bonds.
Yes.
Now, there's more certainty in their revenue line for that matter, and that's why people will go for that. So that risk premium has. So that was actually one of my points. So, thank you for thank you for highlighting it. So, and Robin, then and then plain and simple, the other one is central bank uncertainty. So you've touched on the issue with Trump around the Fed, but the uncertainty is We've seen the ECB has cut rates.
Yes.
In the US, there's doubt now. Again, there's almost a force that they have to cut. Michael spoke about it last week, but now GDP for the first half of this year is much higher. So now suddenly the uncertainty is the Fed again going to sit on its hands. Other central banks in the world, inflation has not gone away. The whole tariff thing has not gone away. So that uncertainty is actually, it's in disequilibrium because normally you have a pattern that everybody cuts simultaneously or hikes simultaneously. So now all over the world there's a disparity on that principle. And then the other factor that comes in is the so-called or risk premium relative to inflation,
Yes.
which the market is also anticipating to be worse for two reasons. The one is inflation is much higher, or the perception is it will stay higher for longer. We're back on that jargon. And then the uncertainty around the fiscal. So suddenly you have this whole risk premium principle moving higher. And then to some extent, people are looking now for alternatives. The alternatives are the crypto markets, the short-term trading markets, and those type of things. Gold is another factor. The whole physical commodity cycle. So they're leaving, actually selling off the bonds to go into those alternatives that might give a quick return type of thing.
Yes.
Robin, it comes back to the whole thing that we've been saying this year, is that word uncertainty.
Yes.
And it's highlighted now again through the bond market. And then the last factor is the bond market 10-year yields are used as a yield into forecasting corporate earnings, all of those things. So now suddenly, you were thinking it's going to be at 4% in the US, now it's closer to 4.5%, and who knows, 5%. So suddenly all of these things just escalate uncertainty. So that's where we are.
So Willie, I mean, it would be very easy at this point to sit down and go, okay, well, I mean, get out my knife or my spoon and start cutting my
spoon,
and like, let's sell all my assets and what have you. But one of the things that's so interesting is we look at the big picture, we do look at what's going on, it's very important, but come back to this thing that we say so often in this office. It's probably been a mantra of ours for 20 years. Countries are not companies. Companies are not countries. We're still finding value, aren't we?
Yeah, Robin, talking of bond markets, there's value now to be found in like South African bonds, because despite all of this, we're talking inflation to 3%. Our yields are sitting at 9.5%. Some of the longer datas is much closer to 10%. So if you look at that arithmetic, then there's value actually in the South African bond market, despite those type of things. So that's back to that concept. When I look at international companies issuing bonds, I look at it relative to the perceived value of that company, and you actually see it gives you an indication. Yes, it's a sound business. Use Caterpillar as an example. When they issue some bonds, and you look at it, you realize, but people have massive trust for 10 years or 15 years in Caterpillar. That's sort of the indication. So. And then you see, but there's still value in a company like that. So back to your point.
Really awesome. Thank you for giving us that insight. Let's hope that the box can do it in Eden Park. Last time we suggested that we had a terrible loss against Australians, so maybe we shouldn't say anything. But thank you for tuning in. Don't forget to like and subscribe, and we'll catch you next time. Bye-bye.
Thank you.